Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with John Mousseau, CEO, Director of Fixed Income. Busy week this week on the news front and in the markets. Moose, fixed income?
Yeah, didn't have the kind of week that equities did. Bonds were off this week. 10-year Treasury really closed the week at about a 4.15. That's up about 22 basis points on the week. What happened? Well, you had a mixture of news this week. You had initial jobless claims less than expected. You had housing starts down, but less than expected. So the consumer is doing fine out there. That's really what the markets are telling you. And so they're kind of backing off a little bit. Now remember, at a 4.15, you say, well, it ended the year at around a 3.88. That's some back off. Got to go back to October when it was over 5%. So right. We're still fine. Plenty of demand for munis, which, we're off maybe half of what treasuries were. At 4%, plenty of demand. And interesting, for the second week in a row, a fair amount of money into municipal bond funds, which is good because it tells you that some of this roll-off from the end of the year is getting reinvested in bonds. So pretty solid.
Okay. Over on the equity side, some backing and filling as we saw all of January until Wednesday afternoon into Thursday. Large caps caught a bid again.
Boom.
Just ripped. Small caps, mid caps, really stuck in the mud. Value, a little bit of a bid there. Be interesting to see over these next 2, 3, 4 weeks if it's going to become that pure growth market again. It was nice to see the breadth expansion we had seen into year end.
Right.
So the other thing I want to do, and John's going to join me, is just a quick history lesson. John has something in history he's going to take a peek at. What I wanted to do, we rarely speak about the international markets. And we do run a global strategy, international strategy, so we watch them very closely. We invest in them closely. Right now, over on the allocation side, we're leaning more developed than emerging. In emerging, we're leaning Latin America and India. They're both working well. Why do I mention that? I want to bring up a chart that I found fascinating. It's on the Dorsey Wright equity report this week. Take a look at the Seng Index. That's the Hong Kong index, right. Moose. It threatened 15,000 again this week. That was within a short 9-iron of where it traded down to during peak COVID in China, which was about 14.8. The important and really fascinating piece of information I want to share with you is it, prior to COVID, had not traded below 15,000 since 2009.
That's an incredible run.
We're back to a scenario where the Hang Seng, the Hong Kong index, is trading within a stone's throw of where it traded in 2009. Let me give you some information on the S&P 500.
It's like you went away for 15 years.
And that's why international has been a tough place to be, because there are other countries and regions that have traded similar, not as poorly.
Right.
But in terms of the S&P 500 during 2009, coming out of the great financial crisis, the low was right in the 700 range. That's 700.
Seems like a long time ago, and it was.
It finished the year up about at 1,100.
Right.
Today we're trading at 4,800.
Incredible.
Amazing that the Shanghai and the Hang Seng over in China have gone literally nowhere in 14 years, almost 15 years. And one of the quick reasons, before I jump over to John, is markets trade on an awful lot of things. Earnings, interest rates. One of the things that rarely gets focused on is confidence. And poor market action over long periods is a lack of confidence in that market. So I bring that up. We are not long China internationally. we are getting oversold enough in those indices to start to at least take a peek.
Yeah.
So we'll see over the next few weeks and months. Moose, what do you have historically?
This week we saw the Iowa caucuses at the beginning of the week. Next week, coming up, we have the New Hampshire primary. So we're getting right into the teeth of the presidential election season. And we hear a lot of banter from people, sometimes clients, sometimes readers, whatever. They're talking about the Fed, and does the Fed play politics in an election year? And our view is that they don't. That they always do what they try to do, which is, do what's right. Whether the economy's improving or in a decline, their idea is to keep inflation low if they can, and to try to keep employment high if they can. And so we took a look and we gave you 4 charts here. And it goes all the way back to 1988. So just 4 elections, but we wanted to give you some flavor. 1988, you have Bush versus Dukakis, and there you have no incumbent running that year. And you can see Fed funds were hiked that year. So, there's nothing to be read into that. That's because they were trying to basically calm the economy down a little bit. 1992, you have incumbent President Bush versus Bill Clinton. Interest rates came down that year with Fed funds, and they were cutting rates. Why? Because they were in somewhat of a recession. Didn't help President Bush, but the idea was the Fed was doing what they thought was right. 1996, now you have an incumbent again, Bill Clinton versus Bob Dole. They cut rates once and then didn't do anything, so it was like a nothing year. And then the last chart was 2000, Bush versus Gore. We know that was a close election, and they hiked rates that year. Because why? Because you were coming off the big tech bubble of 99 and they wanted to cool the economy down. My point is you can't read anything into this. And so we're trying to hope to put to rest the idea that the Fed is political, because we don't think it's true, and the charts show it.
Have their job to do and do their job.
Exactly right.
Great. Enjoy the weekend. We'll be back next Friday. I'm sure we'll have some interesting data to cover.